Welcome to Iron Financial. We're the place where you come to forge a stronger portfolio because we cut right through the market weakness. I'm your lead analyst, and today we are diving deep into a serious paradox, a real head-scratcher in the biotech world, Acurx Pharmaceuticals. That's ticker ACXP. Now you look at their books, you look at their operations, and on paper, it looks like this company is building a fortress. But then you look at the stock chart, and it's trading like a condemned building. So our job today is to figure out what's really going on. Are we looking at a ground floor opportunity here, or is this a trap just waiting to collapse?
Okay, so let's get right to the heart of it. This is the central mystery we have to unravel. Acurx comes out and posts some major operational improvements. I mean, things you love to see. Their net loss slashed by 43%. That's a huge deal. And their cash on hand, they more than doubled it. In any universe, especially for a biotech company, these are incredibly strong vital signs. But what did the market do? It delivered a brutal over 21% beatdown on the stock price. I mean, come on. That kind of disconnect, it just screams that something is going on under the surface. It absolutely demands that we take a much deeper look.
Whoa, hold on a second. Just look at this chart. This doesn't compute. It just makes no sense at all. Over here on the left, you've got this massive green bar, a huge positive. The company is getting its financial house in order. They're burning way less cash. That's fantastic. But then you look to the right and you see this giant red bar plummeting downwards. The market punishes the stock as if they just announced a total catastrophe. So I have to ask, how does a company build a stronger financial foundation, right? They're laying down more concrete, reinforcing the rebar, and yet its market value just crumbles into dust? Is this just irrational market noise, or is there a serious, hidden flaw here that actually justifies this kind of collapse? Something's not right.
All right, here's our plan of attack for today. We're going to tackle this head-on. First, we're going to keep examining this paradox. Then, we'll get to work forging the bull case, using nothing but the raw numbers. After that, we'll do our best to expose the cracks. What is it that the market is really seeing? Then, we'll analyze their official construction roadmap, their plan to move forward. And finally, we will deliver our verdict. Is this an opportunity, or is it a trap? Let's get to work.
Okay, first things first. Let's forge the bull case. And to do that, we're going to do something important. We're going to ignore the stock price for a minute. We're just pushing it to the side. Instead, we're focusing on the fundamentals, the actual steel beams and the concrete that make up the business itself. Let's see how strong this structure really is. Let's start with the absolute bedrock of any small biotech company, cash. You live and die by your cash balance. At the end of 2025, Acurx had $7.6 million sitting in the bank. Now that's more than double the $3.7 million they had the year before. So what does that really mean? It means they bought themselves time. In this sector, cash is oxygen. It's the runway you need to actually execute your plan and get your drug to the finish line. And this wasn't some minor top-up. This is a significant reinforcement of their balance sheet. That right there is a foundational sign of strength.
Now look at the discipline they're showing here. This is impressive. R&D spending dropped by a massive 66% and went all the way from $5.4 million down to just $1.8 million. Now, wait a minute. The first thing you might think is, isn't that a huge red flag? Are they pulling back on their core research? Are they giving up? But it's actually the complete opposite. This shows surgical precision. It tells me they've completed the heavy, expensive lifting of their prior trial phases, and now they are managing their capital with an iron fist. It shows a command structure that knows exactly how to allocate its resources for maximum impact. That's smart management.
And this financial discipline, it extends across the entire company. It wasn't just R&D. As you can see right here in this table, their total operating expenses absolutely plummeted from over $14 million down to just over $8 million. This wasn't some one-off cut to make the numbers look good for a quarter. No, this was a systemic improvement that almost halved their net loss. So what's the key takeaway here? It's that they have engineered a leaner, meaner machine that is built for efficiency. They've tightened every bolt.
But listen, a strong foundation is totally useless if you don't have a powerful product to build on top of it. And folks, here it is. A 96% clinical cure rate for their lead drug ibezapolstat in phase 2 trials for C. diff. Let that sink in. 96%. In the absolutely brutal world of infectious diseases where drugs fail all the time, that is a monster number. That's a grand slam. This right here, this is the steel frame of the entire bull case. This is the powerful engine that's driving this whole operation forward.
And they're not just sitting on that great data, admiring it. They are actively fortifying this asset. They've been busy. They went out and secured a new patent from the USPTO, extending their protection all the way out to 2039. They received positive guidance from the regulators both in the US and in Europe for their big phase 3 trial. And they're launching a very savvy new trial for recurrent infections. Look, these aren't just minor press releases. These are load-bearing achievements that add tangible, long-term value to the company.
And their executive chairman, Robert DeLucia, he sums it all up perfectly. He says they believe they have a drug that can shift the entire treatment paradigm. Think about that. They're not just aiming to treat the infection. They want to prevent it from ever coming back. That is the blueprint for a blockbuster drug, plain and simple. So the bull case is crystal clear. You've got a stronger balance sheet, you've got disciplined spending, and you have a core asset with absolutely massive potential. You've got a foundation of steel.
Okay, that all sounds great. I'll admit it. The numbers look good, the drug looks really promising. But here's the thing. The market isn't stupid, and a 21% drop tells me, loud and clear, that it sees a major crack in that foundation. It's found a weak point. So now it is time for us to put on our hard hats, grab a flashlight, and go find it.
And here it is. Here is the first crack we've found. That $7.6 million in cash that you were just celebrating? Well, their very next step, this pilot trial for recurrent C. diff, is estimated to cost somewhere between $4 and $5 million. All of a sudden, that's not a fortress treasury, is it? No, that's a razor-thin safety net. It leaves them with almost no room for error, no room for delays, no room for anything to go wrong.
Exactly. That $4 to $5 million, that's just for the small 20-patient pilot. The real heavy lifting, the final massive, incredibly expensive Phase 3 registration trial, that's going to cost tens of millions more. That $7.6 million isn't going to build the skyscraper, it barely pays for the blueprints. So the market is looking at this situation, and it's asking a very simple and, frankly, a very scary question. Where does the real money come from to get this done?
And this slide right here gives us the answer that every single investor fears, the S3 shelf registration. Let's be perfectly clear about what this is. You can think of it as a pre-approved $50 million permission slip from the SEC that lets them print and sell new shares of stock whenever they want for whatever price they can get. And you need to understand, every single time they use this, your piece of the pie gets smaller. It is essentially a planned demolition of shareholder value, just hanging over the stock like a guillotine.
And don't you dare think for a second that this is some far-off theoretical threat. It is happening right now, as we speak. Just look at this chart. The number of shares outstanding went from about 851,000 to over 2.3 million in a single year. That's a nearly threefold increase. They have already massively diluted their existing shareholders just to get to this point. And what the market sees is a pattern. It assumes, probably correctly, that this pattern has to continue.
And it's not just the S3 shelf they have to worry about. They are actively using other tools to raise cash. In 2025 alone, they pulled down about $4 million through something called an equity line of credit, or an ELOC. It's just another spigot that they can turn on whenever they need cash, flooding the market with more and more stock. It all points to the exact same outcome: more dilution and more downward pressure on the stock price.
This summary from Stock Titan just nails it. It says, a negative reaction despite operational improvements fits a pattern where financing needs and dilution weigh on sentiment. That sentence right there, that is the entire bear case in a nutshell. The market is looking past all the good operational news because it sees a company that is structurally dependent on the capital markets just to survive. That amazing clinical data is just hype until it's paid for, and the market is worried they can't pay the bills.
All right, so the battle lines are drawn. It's a classic Wall Street showdown. On one side, you have a solid operational foundation. On the other, you have these deep, concerning cracks in the financing structure. So now, let's look at the company's official construction roadmap to see how they actually plan to bridge that gap and get this project finished.
Their plan, to their credit, is a clear, logical three-step process. Step 1, launch this small 20-patient pilot trial. It's a smart, capital-efficient move to get some crucial early data. Step 2, use the data from that small trial to intelligently design the big, expensive Phase 3 trial. And then, Step 3, initiate that final registration trial. You have to admit, it's a very methodical and prudent approach.
Methodical, yes, I'll give you that. But it's also incredibly slow. Enrollment for this tiny little pilot study doesn't even begin until the second half of 2026. Then, it could take another 12 to 15 months just to get all 20 patients into the trial. We are talking about a long, long road just to get results from this very preliminary step. And guess what? Every single month that ticks by on the calendar, they are burning through that precious cash. This timeline doesn't reduce the financing risk. If anything, it highlights it.
But look, management knows this. They're not blind to the timeline, and here is their stated toolkit for funding the build. They have their existing cash, that's $7.6 million. They've got another $7 to $8 million left on their ELOC they can tap into. They've got the big $50 million S3 shelf waiting in the wings, and very importantly, they are in ongoing discussions with government agencies like BARDA for what's called non-dilutive funding. That's money that doesn't involve selling stock. So they have a multi-pronged financing strategy. This isn't just wishful thinking, they have options they can pursue.
Okay, that brings us to the final showdown, the moment of truth. We've laid out both sides. Now it's time for the verdict. Is this thing an opportunity, or is it a trap?
My verdict is this. This is a company that is methodically forging a solid foundation on which to build something of immense value. You simply cannot ignore a 96% cure rate. You can't ignore the sharply reduced costs and the streamlined operations. And you can't ignore the clear clinical path forward. The core asset is undeniably strong. Right now, the market is getting spooked by the noise of the cranes and the sight of the financing bills. It is mistaking the necessary costs of construction for a fundamental structural weakness, and I believe that is a mistake. And my verdict is that the clinical data, as exciting as it sounds, is nothing but hype until every single last dollar for its development is sitting securely in the bank. This company isn't a builder, it's a borrower. It is completely dependent on the capital markets opening up their wallets again and again and again. Every single step forward on their own roadmap requires more dilution of your shares. The market isn't mistaking anything. It sees the massive gaping cracks in that financing model, and it is absolutely right to be terrified. This isn't a foundation. It's a house of cards.
So, there you have it, the Acurx paradox, laid bare for you to see. Is this a solid foundation being built? Brick by painful, dilutive brick with a massive potential payoff waiting at the very end of a long road? Or is it just a house of cards, teetering, just waiting for the next financing bill to come due and knock the whole thing down? That is the question you have to answer for your portfolio. Thanks for joining us here at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.